You woke up this morning expecting your money to behave the way it always has. You check your account. You see the same balance, the same numbers, the same familiar interface. Everything looks normal. And that is exactly why this is so easy to miss. Because the most dangerous changes in a financial system rarely announce themselves as a crisis. They arrive as a routine update, a quiet adjustment, a line of text that says, the bank is making temporary changes for system stability effective immediately. No panic, no headlines, no press conference, just a new set of rules sitting where the old rules used to be. Here is the point most people never separate in their minds. Owning money and accessing money are not the same thing. You can have a full balance on a screen and still lose the one thing that actually matters in a tight moment, the ability to move it, withdraw it, or use it on your schedule. This isn't coincidence. When access starts changing faster than explanations, you are not watching customer service. You are watching risk management. And risk management is always about priority. Not what is fair, not what feels normal, but who gets processed first when the system is under strain. When conditions tighten, institutions don't protect everyone equally. They protect the system's plumbing. They protect settlement. They protect the flows that keep the machine running. This pattern has appeared before, and it always begins the same way, not with people losing their money, but with people discovering that permission has replaced certainty. Once this stage begins, the question is no longer, is my money safe? The question becomes, if I need it quickly, will I be treated as the priority or as the exception? Most people are trained to watch the wrong signals. They are taught to ask whether a bank is strong, whether it is profitable, whether it passes stress tests, whether deposits are insured. Those questions made sense in an earlier era when failure arrived as a collapse. Today, failure rarely looks like a fall. It looks like a narrowing. The modern financial system does not need banks to fail in order to change your experience. It only needs conditions where liquidity becomes more valuable than convenience. When that happens, the system does not break its promises. It reinterprets them. Your balance still exists. Your account is still active. The institution remains open. What changes is the order in which requests are honored and the speed at which permission is granted. This is where most people misunderstand what safety actually means. They assume safety is about permanence, about whether the institution survives. But safety in a stressed system is about priority. It is about who moves first, who waits, and who is told to come back later. This isn't coincidence. The moment language shifts from customer experience to system stability, the center of gravity has already moved. What feels unsettling is not that rules change. Rules always change. What feels unsettling is how quietly they change. A reduction becomes an adjustment. A delay becomes a processing review. A restriction becomes a temporary measure. None of these words imply danger, yet all of them describe the same thing: access is no longer assumed. It is conditional. This pattern has appeared before in different forms in different decades, but the logic is consistent. When systems are under pressure, they stop optimizing for individuals and start optimizing for continuity. Continuity requires control. Control requires friction. And friction shows up first, not as loss, but as inconvenience that keeps getting harder to explain away. Once the stage begins, people instinctively look for reassurance in balances, statements, and guarantees. But those are static snapshots. They do not tell you how the system behaves when multiple demands collide at the same moment. The real signal is not what you are allowed to do on a calm day. It is what happens when many people try to do the same thing at once. Understanding that distinction does not mean panic. It means clarity. Because a system that is stable on paper can still be selective in practice. And when selectivity enters the picture, the rules you thought were universal quietly become situational. To understand what is happening, you have to stop looking at individual announcements and start looking at sequence. Systems do not change behavior randomly. They move through recognizable stages, especially when pressure builds slowly and denial lasts longer than it should. This pattern has appeared before, and it always begins with stress that feels abstract. Interest rates rise, funding costs creep higher, and liquidity becomes more expensive behind the scenes. Nothing breaks, nothing headlines, but the system starts behaving defensively. Balance sheets tighten. Interbank lending becomes cautious. The first stage is invisible to most people because it lives in spreadsheets and internal risk meetings, not in public statements. The second stage introduces reassurance language. Institutions sense tension, but they are careful not to amplify it. Communication emphasizes stability, resilience, and strength. Customers are told there is nothing to worry about. And in a narrow sense, that is true. There is no immediate danger. But this is the stage where wording begins to matter more than numbers. When explanations lean heavily on confidence rather than clarity, the system is preparing for adjustment. Then comes the third stage, where behavior changes before rules do. Processing times lengthen, limits are reviewed, exceptions become harder to obtain. Everything still works, just not as smoothly as before. This is not framed as restriction. It is framed as optimization. Internally, the goal is simple: slow things down just enough to reduce strain without triggering alarm. The fourth stage is where selectivity becomes visible. Different users experience different outcomes. Some transactions move quickly, others wait. Some requests clear instantly, others are flagged for review. Nothing is officially denied, but not everything is treated equally. This isn't coincidence. When a system starts sorting requests by impact rather than order, priority has replaced neutrality. The fifth stage normalizes what once felt temporary. Measures introduced as short-term remain in place. People adapt. They change behavior. They stop questioning delays that would have seemed unacceptable before. At this point, the system has successfully shifted expectations without ever declaring a rule change. What was once assumed is now conditional, and most people adjust quietly. The final stage is acceptance. The new operating environment becomes the baseline. The system does not announce victory. It simply moves on. Those who noticed early understand that something fundamental has changed. Those who did not only realize it when they attempt to act quickly and discover that speed is no longer guaranteed. And once this stage begins, reversals are rare. Systems that introduce friction under stress rarely remove it without a clear reason. Not because of malice, but because control, once justified, becomes difficult to relinquish. This sequence does not require collapse. It requires pressure, caution, and time. And that is why it is so often misunderstood until it is already complete. To see why systems behave this way, you have to look beneath policy language and public messaging and into the mechanics that actually keep financial institutions alive under stress. What looks arbitrary from the outside is often a rational response to structural constraints that most people never see. Banks and large financial institutions operate on a timing mismatch. Deposits are available on demand, but the assets those deposits fund are locked for much longer periods. Loans, bonds, and structured products cannot be instantly converted into cash without loss. Under normal conditions, this mismatch is invisible because inflows and outflows roughly balance. Under stress, timing becomes everything. Liquidity, not profitability, becomes the limiting factor. This is where the distinction between solvency and liquidity matters. An institution can be solvent, meaning it owns more assets than liabilities, and still struggle to meet immediate cash demands. When that happens, the system's goal is not to maximize convenience, it is to prevent forced selling. Forced selling destroys asset values, which then creates real solvency problems. From the institution's perspective, slowing access is often safer than liquidating assets at unfavorable prices. This isn't coincidence. The first controls to appear are rarely explicit prohibitions. They are friction. Friction buys time. It spreads demand across longer intervals. It reduces the chance that many people will act simultaneously. In technical terms, it lowers peak load. In human terms, it turns urgency into patience. Regulation reinforces this behavior. Modern banking rules require institutions to maintain specific liquidity ratios and stress buffers. These are measured not just by how much money exists, but by how quickly it can be accessed under adverse scenarios. When indicators approach thresholds, management is compelled to act preemptively. Waiting until limits are breached invites regulatory intervention, reputational damage, or worse. Quiet adjustments are often preferred to visible enforcement. There is also a hierarchy of flows that most account holders never think about. Settlement systems, payroll clearing institutional obligations, and government-linked transactions sit at the core of the financial plumbing. These flows must continue, or the system risks cascading failure. Individual convenience, while important, is secondary to continuity. When pressure rises, resources are directed toward keeping the core intact. This pattern has appeared before across different financial environments, and the logic is consistent. Control is applied where it creates the least visible disruption, while producing the greatest systemic relief. Retail users experience delay. Large counterparties experience accommodation. From the system's perspective, this is not favoritism, it is triage. Another mechanism at work is behavioral. Financial systems are sensitive not only to balance sheets, but to expectations. If everyone believes access is unlimited, behavior clusters. If access becomes uncertain, behavior spreads out. Even minor restrictions can dramatically reduce simultaneous demand simply by introducing doubt. That doubt is not accidental, it is stabilizing. Once the stage begins, reversibility becomes difficult. Removing controls requires confidence that pressure has permanently eased. Temporary stress often becomes prolonged uncertainty. In that environment, maintaining friction feels safer than restoring speed. Over time, what began as protection becomes protocol. Understanding this mechanism changes how you interpret what you see. A stable balance does not mean a stable experience. Institutional calm does not mean individual flexibility. And silence does not mean nothing is happening. It often means the system is doing exactly what it was designed to do, protect itself first quietly before stress turns into something it can no longer manage. History offers clarity here, not through dramatic collapse, but through repetition. Whenever access to money has been constrained in the past, it has rarely begun with confiscation. It has begun with pauses, holidays, and temporary measures introduced in the name of stability. In the early 1930s in the United States, banks did not fail all at once. Confidence eroded unevenly, withdrawals accelerated, and institutions responded by limiting activity before outright closures occurred. The bank holiday that followed was not framed as punishment or loss. It was framed as protection. Deposits were not erased. They were frozen. The system survived, but the experience of money changed. Access became conditional on reopening schedules, approvals, and new rules that did not exist before the stress arrived. A similar logic appeared decades later during sovereign debt crises in Europe. Controls were not introduced because money disappeared, but because demand to move it surged faster than the system could safely accommodate. Daily withdrawal caps, transfer reviews, and cross-border restrictions were labeled temporary safeguards. In practice, they reshaped behavior for years. People adjusted not because they agreed, but because the system no longer offered the old alternative. This pattern has appeared before, and it carries a consistent lesson. Once access is restricted under stress, it is rarely restored quickly, if at all. More recent examples reinforce the same mechanism in quieter ways. During financial shocks in the modern era, institutions have repeatedly imposed limits on redemptions, transfers, and liquidity without declaring crisis. These actions were legal, measured, and justified. They were also asymmetric. Large counterparties retained flexibility. Smaller participants absorbed delay. Nothing was seized. Yet the promise of immediate access quietly weakened. This isn't coincidence. Each of these episodes followed the same sequence. Pressure built beneath the surface, reassurance preceded adjustment, friction appeared before rules were rewritten, and by the time the public fully understood what had changed, the new structure was already normalized. What history shows most clearly is that systems rarely reverse these measures simply because stress subsides. Controls introduced as temporary often linger because they solve more than one problem. They reduce volatility, discourage coordinated exits, and grant institutions more room to manage future shocks. Removing them requires confidence not only in the present, but in the absence of future pressure. That level of certainty is rare. Once this stage begins, the burden shifts quietly from institutions to individuals. People are expected to adapt to new timelines, new expectations, and new definitions of normal. The system does not apologize for this shift, it rationalizes it. And over time, memory fades. What once felt extraordinary becomes routine. The historical record does not suggest malice, it suggests incentives. Financial systems under strain choose continuity over convenience every time. They do not announce this choice as a loss. They present it as prudence. And those who recognize the pattern early understand that the most important changes are not always the loudest. They are the ones that arrive calmly, stay quietly, and alter behavior, long after the moment that justified them has passed. When you map that sequence onto the present environment, the alignment becomes difficult to ignore. The same ingredients are in place, but expressed through modern channels and modern language. Pressure is not arriving as a single shock. It is arriving as accumulation. Higher rates persist longer than expected. Asset values adjust unevenly. Funding costs remain elevated. And institutions quietly recalibrate behavior to match a tighter reality. What stands out is timing. Many of the recent adjustments have appeared after weekends at quarter ends or following regulatory reporting cycles. That is not random. Those are moments when systems assess exposure, compare assumptions against reality, and decide whether buffers are sufficient. When changes cluster around those windows, it signals coordination with internal thresholds, rather than reaction to headlines. The language used today mirrors earlier stages with remarkable consistency. Terms like operational resilience, temporary measures, and customer protection appear alongside changes that slow movement without denying ownership. This isn't coincidence. Systems under strain prefer ambiguity to alarm. Ambiguity buys flexibility. It allows institutions to adapt without triggering behavior that would intensify pressure. Another signal is uniformity. When multiple institutions adopt similar adjustments within a narrow time frame, the cause is rarely individual mismanagement. It points to shared constraints, shared models, shared regulatory expectations. In other words, a system responding as a system. When that happens, individual choices shrink, even if individual balances remain intact. This pattern has appeared before in moments when stress was real but politically inconvenient to name. No one benefits from declaring crisis too early, but waiting too long risks losing control. The compromise is incremental change, small enough to defend, broad enough to matter, quiet enough to normalize before it is widely discussed. Once this stage begins, attention shifts away from price signals and toward behavior. Not what markets say, but what institutions do. Delays replace denials, reviews replace approvals, priority replaces order. None of this requires public coordination. It emerges naturally when incentives align around preservation rather than expansion. What matters most is not whether any single adjustment seems justified in isolation. It is whether the direction of travel is consistent. When access becomes slightly slower, slightly more conditional, and slightly more differentiated across users, the system is revealing its priorities. Stability is being protected upstream. Flexibility is being absorbed downstream. Understanding this does not require predicting collapse or assuming worst-case outcomes. It requires recognizing where the system currently sits within the sequence. The signs suggest we are no longer in the reassurance phase. Behavior has already shifted. Friction has already been introduced. And once that happens, the experience of money changes before the definition of money does. Once this stage begins waiting for a formal announcement, often means waiting past the point where choices are widest. The system does not move backward on convenience without a reason. It moves forward on control because control reduces risk. And in periods like this, reducing risk quietly becomes the central objective, whether it is spoken aloud or not. At this point, the conclusion follows from the structure itself, not from speculation. What is unfolding is not a temporary inconvenience layered on top of an otherwise unchanged system. It is a shift in how access is treated when stability becomes the primary objective. Ownership remains visible. Control becomes conditional. This is not a failure scenario. It is an optimization scenario. Systems designed to survive stress do not prioritize speed or symmetry. They prioritize continuity. And continuity requires discretion over who moves first, how fast, and under what conditions. That discretion is exercised quietly because noise creates behavior and behavior creates risk. This isn't coincidence. When access rules soften without fully returning to their previous state, the system is signaling that its tolerance for frictionless movement has narrowed. The promise has changed even if the language has not. What once felt automatic is now situational. What once felt guaranteed is now dependent on context. This pattern has appeared before and it always resolves the same way. The system does not announce a turning point. It lets users adapt. Those who notice early adjust expectations. Those who do not continue operating under assumptions that no longer hold. The system does not correct them. It simply processes their requests under the new reality. Once this stage begins, the most important shift is psychological. People stop thinking in terms of absolutes and start thinking in terms of windows. Not whether access exists, but when it exists. Not whether funds are available, but under what conditions they move. That change alone alters behavior, reduces pressure, and achieves the system's objective without overt force. This is the unavoidable outcome of prolonged stress managed incrementally. There is no villain in this process. There is no single decision that can be reversed to restore the past experience. The system has already adapted to a different risk environment. And when that happens, returning to a fully frictionless model is not a priority. Stability has taken its place. The rules did not disappear. They evolved. And understanding that evolution is the difference between being surprised by the new normal and recognizing it as the logical result of everything that came before. The appropriate response at this stage is not urgency, it is orientation. When systems shift from convenience to control, the advantage belongs to those who understand how access actually works, not to those who react emotionally to surface changes. The first adjustment is mental. Stop treating access as binary. It is no longer something you either have or do not have. It is something that varies by timing channel and priority. That means decisions should be framed around flexibility rather than assumptions. What matters is not whether funds exist, but how many paths exist to reach them under different conditions. The second adjustment is observational. Pay attention to language, not reassurance. Systems signal change through wording long before they formalize rules. When explanations emphasize stability, protection, or operational resilience, they are describing internal stress in neutral terms. Those phrases are not warnings, but they are indicators. They tell you what the system is optimizing for. The third adjustment is structural thinking. Any arrangement that depends on a single point of access assumes a level of certainty that no longer exists. The goal is not to escape the system or challenge it, but to avoid being forced into narrow windows where options shrink. Choice is widest before pressure peaks, not after. This is not about predicting outcomes. It is about reducing dependency on timing you do not control. Systems reward those who plan for variability, not those who assume continuity. When access becomes conditional, preparation is not an act of fear. It is an act of alignment with how the system now behaves. The system is already adjusted. The only question is whether your expectations adjust with it or remain anchored to rules that quietly no longer operate the way they once did. There is one place where this shift becomes even more consequential and it receives far less public attention than banks ever do. That place is where money is locked by design, not by circumstance. Where access is already delayed, already conditional, and already mediated by rules most participants never read. If access to ordinary bank deposits can be slowed quietly in the name of stability, the question that follows is unavoidable. What happens inside systems that are built on delayed access from the start? What happens when stress reaches structures where liquidity is not assumed but rationed by policy? That is the question we need to examine next. Because when people discover limits in places they believed were untouchable, the adjustment is not gradual, it is abrupt. And the window to respond is often measured not in months, but in days. In the next discussion, we will look at what happens when pension funds and long-term retirement vehicles enter this same phase of control, not hypothetically, but mechanically. Because when access rules change inside systems designed to hold money for decades, the consequences do not show up on a screen. They show up when someone tries to act and learns the clock has already started.